Hello, it's Kevin Thompson, your investment advisor representative, and welcome to the Extra Innings 5-minute market update. As we begin year 3 of the pandemic, its consequences are becoming more visible. Supply chain disruptions have caused upticks with inflation due to rising demand and labor shortages. The question remains for all of us: what will the Fed do if inflation becomes more persistent? In this current market environment, you're seeing a revaluation not only of inflation expectations, but Federal Reserve interest rate expectations. Going into 2022, market participants like myself believed that the Fed would raise rates 2 or 3 times. Now it's believed that the Federal Reserve may raise rates a 4th time and have to be more aggressive with interest rates to combat inflation. The market is digesting what the Fed is actually trying to do and if it will actually raise rates 4 times in 2022. The consequence is that many of the high valuation companies, especially those in the NASDAQ, have seen a reduction in value, quote unquote, a correction. The multiple expansion that we once knew over the past 3 to 4 years has seen a quick correction back to a normalized value. The Federal Reserve easy money policy is now being removed from the markets, and companies that have little to no earnings will have trouble getting favorable lending. This does not mean we throw every company out. There are a lot of companies out there, good quality companies that are making money and deserve higher price to earning ratios. So, what do we do? First, remaining diversified across multiple asset classes, whether it be growth, value, international, commodities, utilities, what have you, is imperative at this time. It's important that we understand why we invest. It's important that we understand that we have a longer term time horizon, and to really ask yourself this question: will the market be higher in 5 years, 7 years, 10 years? If you can say yes to any of those, then the market is cheap. The United States economy will continue to grow, albeit at a much lower rate. The returns of 28% that we saw in 2021 need to be adjusted downward to a more conservative level of 2 to 5%. Markets will always have periods of volatility, and as long as we remain invested, studies show that over time, markets typically move higher. So, in conclusion, 1, markets have been volatile over the past several sessions, especially here in January. Reason being is because interest rates, the Fed, inflation, all of these factors are causing the repricing of equities. 2, understanding why we invest and knowing that we're invested for the long term will minimize any of the short-term emotions that we're feeling right now. So remaining invested, also systematically reinvesting, will get you to where you want to go, knowing that over the longer term, the markets generally are positive. And finally, thank you guys for listening for the Extra Innings Market 5-minute update. I hope this has been a value add to you. Please, if you have any questions, go to my website, www.9inningscapitalgroup.com, or you can give me a call at the office or send me an email at kevinthompson@9icapgroup.com. Thank you, and I'll see you soon.